All right, ready to dive in. Today we're looking at what I learned about investing from Darwin.
By Pulak Prasad.
Yeah, exactly.
Yeah.
The title itself, it kind of makes you stop and think for a second. Investing in Darwin. What's the connection?
Yeah, and that's what makes this book so interesting. Prasad, he doesn't just talk about, like the usual financial stuff.
Right.
He spent decades, really looking at businesses, not just the numbers,
Yeah.
but how companies, industries, they kind of evolve over time.
Yeah.
And that's where, the whole Darwin thing comes in. He uses these like evolutionary principles to try to figure out what makes a business really thrive,
Interesting.
survive, in the long run.
So it's more than just like your typical investing book. We're not just looking at spreadsheets.
Not just spreadsheets, no. It's more like taking a safari through the business jungle,
Okay, I like that.
He lays out these 3 core principles. First, how do you avoid those big, like, catastrophic risks? The kind that can just wipe you out.
Right, like a predator sneaking up on you.
Exactly, yeah. Then second, how do you spot those really high-quality businesses?
The ones that are going to last.
Yeah, the fittest of the bunch, that's a good way to put it. The ones that can deliver those sustainable returns.
Yeah.
And then the third one, this is the one that really got me. Don't be lazy. Be very lazy.
Lazy investing. That's definitely not what you usually hear.
Right. It's kind of a head scratcher. But before we get to that, let's talk about avoiding those risks, those big ones.
Okay, yeah, the scary stuff.
This is where, he brings in Warren Buffett's famous rule. Rule number 1, never lose money. Rule number 2, don't forget rule number 1.
Simple, but powerful.
Right. Sounds simple enough, but putting it into practice, that's the tough part.
Yeah. So how do we do that?
Well, he uses this really great analogy, Imagine a deer at a watering hole.
Okay.
Before it takes even like a sip of water, it's constantly scanning, looking around, right? Hyper aware of anything that could be dangerous, any predators. Because even a small mistake, one moment of carelessness, that could be it.
Fatal.
Yeah. So he's saying we need to be like that deer.
Always on guard.
Always on the lookout for potential danger in our investments.
Okay, so how do we spot those dangers?
He calls it minimizing what he calls type I errors. It's when you act too quickly.
Impulsively.
Yeah, when you should be being cautious. It's those risky bets that can just blow up your portfolio.
Gotcha.
But then there's the flip side, type 2 errors. That's when you miss out on a good opportunity because you're too afraid to act.
So it's finding that balance, isn't it?
Exactly, yeah. And Prasad, he argues that nature often favors avoiding those type I errors, those potentially deadly mistakes.
Right.
Even if it means sometimes missing out on a potential gain. Think about it. A deer that's like too cautious might miss a few meals, but a deer that's too reckless, it's going to end up as someone else's meal.
That's a good way to put it. So how do we apply this to like actual investing?
It means doing your homework, really understanding the business, the management team, the industry, avoiding companies with too much debt or those in shaky industries. It's not just about the potential upside, it's also about looking at the downside.
Protecting yourself.
Exactly. And he tells this story, from his own experience that really illustrates this.
Oh, yeah.
He lost a $50 million investment once.
Wow.
Because he ignored these subtle warning signs about the person running the company.
So everything looked good on paper.
Yeah, everything looked great on paper, but he had this gut feeling that something wasn't quite right. He learned the hard way that sometimes you got to trust your gut.
Interesting. So it's about being aware of that confirmation bias.
Yeah.
We tend to only see what we want to see sometimes.
Exactly, yeah. It's easy to get caught up in the hype, but real due diligence means questioning your assumptions, looking for those cracks in the facade.
Okay.
And that brings us to another type of investment that Prasad's particularly wary of, turnarounds.
Turnarounds, like trying to fix a company that's already struggling.
Yeah, exactly. He uses the examples of IBM and JCPenney to illustrate this.
Oh, damn.
IBM, under Lou Gerstner, they managed this incredible turnaround, right?
Right.
But JCPenney, under Ron Johnson, it was a total disaster.
So it's unpredictable.
Exactly. You're betting on the management team to pull off this really complex, uncertain plan.
So even with the best captain, you can't always steer the ship through a hurricane.
Exactly, yeah. It really makes you think, how do you balance minimizing risk with actually going after those potential opportunities? It's a tough question every investor has to wrestle with.
Definitely. It's a tough one. Okay, so moving on, in the second part of the book, Prasad kind of shifts gears a bit, right?
It does, yeah.
From, like, just avoiding risk to actually picking investments.
Right.
He talks about buying high-quality businesses.
At a fair price.
Yeah, at a fair price. Sounds straightforward enough. But what's the secret? How do we actually do that?
It's not about chasing those, like, hot stock tips.
Right.
Or getting swept up in, the market hype.
Right.
Prasad, he's all about finding those companies that are built to last.
Oh.
The ones that have those kind of like inherent strengths that can help them get through those tough times, the inevitable ups and downs of the business world.
So we're looking for the strong foundation, not just a shiny exterior.
Exactly, yeah. And he uses this really cool analogy to explain this. Dmitry Belyev's silver fox experiment.
Okay, I'm not familiar with that.
So Belyaev, he was a scientist, he bred foxes, but he only bred them for tameness. And what he noticed was that this one thing, this selection for tameness, it actually led to all these other changes.
Really?
Yeah, like floppy ears, a more playful personality.
Interesting. So focusing on one trait kind of unintentionally brought along all these other positive ones.
Exactly. And Prasad, he believes that focusing on companies with high ROCE, which is return on capital employed, it's kind of like selecting for that tameness in those foxes.
Oh.
High ROCE, it often signals that a company has a lot of good qualities. Strong management, efficient operations, smart capital allocation.
Okay, I think we might need a quick definition here.
Yeah.
For those of us who aren't, finance experts, break down ROCE for us. What does it actually mean?
Sure. So ROCE, it basically measures how well a company is using its money to make profit. It's calculated by taking the operating profit and dividing it by the capital employed.
Okay.
And a higher ROCE, it generally means that the company is using its resources more efficiently. They're squeezing more profit out of every dollar they invest.
Got it. So if we're looking for those fittest businesses, high ROCE, that's a good place to start.
Yeah, it's a really good indicator. And Prasad, he emphasizes looking at the historical ROCE, not just the projections.
Okay.
He wants to see a track record of good performance, not just promises about the future.
So past performance might not guarantee future results, but it does give you some idea of how a company has operated in the past.
Exactly. Yeah, it shows you what they're capable of. And get this, the companies in Prasad's own portfolio, which he considers high quality, they have a median historical ROCE of 42%.
42%? Wow. Okay, that's impressive.
Yeah, it is.
But does that mean we should just be, like, blindly chasing companies with super high ROCE?
Well, not necessarily. High ROCE is a good signal, but it's not the only thing that matters. Prasad really emphasizes that you need to understand why a company has a high ROCE.
Okay, so it's not just the number, it's the story behind it.
Right. Like, is it because they have some real, sustainable competitive advantage? Or is it something else?
Right.
He gives this example of Havel's. It's a company in his portfolio. They acquired Lloyd Electric.
Yeah.
Now, Lloyd, they were financially sound, but the acquisition raised some questions about the cultural fit, whether the two companies would really mesh well together.
So sometimes the numbers look good, but there are other factors to consider.
Absolutely, yeah.
Yeah.
And that brings us to this, like, common critique of using historical data. The past doesn't always predict the future. What about new technologies? Changing consumer behavior, all those unpredictable things.
That's a good point. So how does Prasad address that?
He acknowledges that, yeah, the future is uncertain, but he argues that looking at a company's past performance, it can still give you some valuable clues.
Okay.
It shows you how the management team has dealt with challenges, how they've allocated capital, how they've built resilience.
So it's like looking at a tree's rings. You can see how it's weathered storms, droughts, all of that.
Yeah, that's a great analogy. It gives you a sense of its inherent strength. And that brings us to this, like, really crucial question for every investor. How do you cut through all the noise and identify those businesses that have genuinely sustainable advantages in a world that's constantly changing?
Yeah, it's like finding a needle in a haystack, isn't it?
Yeah.
There's so many companies, so many factors to consider. Yeah, it can be overwhelming. Which brings us to this really interesting concept Prasad talks about. Don't be lazy. Be very lazy. I got to admit, I'm still trying to wrap my head around that. How can you be lazy and a successful investor?
Yeah, it sounds kind of counterintuitive, right?
Yeah.
But it's all about shifting away from that, like, frantic, always-on approach to investing that a lot of people have. It's more about patience, discipline, letting your investments just kind of simmer.
So not constantly checking your portfolio, not jumping in and out of the market all the time.
Exactly, yeah. He compares it to, the theory of punctuated equilibrium in evolution.
Refresh my memory.
So basically, species, they often stay pretty stable for long periods, and then they have these sudden bursts of change. And Prasad, he argues that high-quality businesses, they tend to perform well over time. So you don't need to be constantly trading. In fact, it might even hurt you.
So it's about finding those companies that can, like, weather those storms and thrive during those stable periods.
Exactly. And this, what he calls lazy approach, it actually makes you a more careful buyer
Okay, how so?
because you're not always rushing to make the next trade. You can really take your time, do your research, wait for those really great opportunities.
So it's about quality over quantity, finding those rare gems and then holding on to them.
Right. And this leads to another really fascinating concept he talks about, convergence.
Convergence.
Yeah, so just like, unrelated species in similar environments, they can evolve similar traits,
Yeah,
right?
sharks and dolphins,
Right.
right, with their streamlined bodies.
Yeah, exactly. Well, he's saying that businesses across different regions, they often face similar challenges, and they show similar patterns of success or failure.
So we can learn from those patterns, get some insights into the risks and opportunities of certain industries, certain business models.
Exactly, yeah. Like, he points to the airline industry as an example.
Okay.
Airlines, they're known for, like, really fierce competition. They're really susceptible to economic downturns.
Right.
So even if you find an airline that looks like a good deal, you have to consider the risks of the industry itself.
So it's like, even if there's a particularly plump deer at the watering hole, if you know it's full of predators, you might want to stay away.
Exactly. And this long-term perspective, it helps you tune out all the noise. He talks about the difference between what he calls proximate and ultimate factors in investing.
Okay, I'm intrigued.
So proximate factors, those are like the headlines, the market rumors, those short-term fluctuations.
Things that everyone freaks out about.
Exactly, yeah. But they often distract you from the ultimate drivers of a business's success.
Like what?
Their competitive advantage, their management quality, their resilience, those are the things that really matter over the long term.
So it's about looking beyond the surface to the deeper currents underneath.
Exactly. And he shares some of his own experiences, like resisting the urge to sell during market panics. He held on to companies like WNS and Page Industries even when their stock prices were plummeting.
Wow.
Because he believed in their long-term strength. And those companies, they ended up delivering these phenomenal returns.
So it's not just about picking the right stocks. It's also about having the discipline to stick with them, even when things get tough.
Yeah, that's a big part of it. He also talks about Shree Cement, a company he invested in. And the stock price, it doubled shortly after he bought it.
Right.
But he didn't sell. He held on because he believed in the company's potential over the long term. And the stock, it just kept going up. It really shows the power of compounding.
So letting your investments, mature, not pulling them up too early.
Right. And he argues that a lot of investors, they actually sabotage themselves by selling too soon. They miss out on those really big returns that come from long-term compounding.
But what about people who would say, well, at some point, returns diminish? Wouldn't it make more sense to sell and put your money somewhere else where it might grow faster?
Yeah, that's a good question. And Prasad, he addresses that. He says that even if the rate of return slows down a bit, the power of compounding over a really long period, it can still generate a lot of wealth. It's like that snowball rolling downhill, right? It starts small, but as it gathers more snow, it just gets bigger and bigger, harder to stop.
Yeah, love that analogy. So it's about letting that snowball keep rolling. And he also talks about the psychological benefits of this approach too, right? Less stress, more peace of mind.
Definitely. When you're not constantly buying and selling, you free up a lot of mental energy. You can focus on actually understanding the businesses you own and enjoying the process.
Yeah, it sounds like a much more sustainable way to invest, honestly.
I think so too. It's about aligning your investment strategy with your personality, your goals.
So instead of trying to outsmart the market, we should be focusing on building a portfolio that reflects our values, our risk tolerance, our long-term vision.
Exactly, yeah. And that brings us back to that message. Don't be lazy. Be very lazy. It's really a call to be more thoughtful, more deliberate, less reactive.
I love that. This whole deep dive has really given me a lot to think about. It's not about chasing those quick wins. It's about playing that long game.
Exactly. It's about understanding those principles that drive success, both in nature and in business.
Well, that about wraps up our deep dive into what I learned about investing from Darwin. I hope everyone listening got some valuable insights out of it. and some food for thought.
Me too. It's a really fascinating book.
It is. And until next time, happy investing, everyone.
Yeah.